big, really, really big lenders, hard money lenders, for example, they could be backed by hedge funds in New York. They could be backed, by their own debt fund, Reg A, something like that. So, or warehouse line of credit from a bank. The smaller lenders like myself, we tend to either be self-funded, so it's called balance sheet lending. So it's capital we have injected into the business that we are then lending out. We can also do brokering, which is another model a lot of smaller lenders use. So people within their network in some capacity, whether that is friends, family, associates, other real estate investors, they just need capital placed for a period of time. Maybe it's a fix and flipper that just needs a year off from fixing and flipping for health reasons, right? Like I have $100,000 that I was going to pour into my next project, but now I need to take a moment. I need to take a year off and help, mom and dad into a nursing home, for example. So we can help place capital that way. So that allows them to get income, and then we are also matching them with a borrower. So the borrower's getting a project done. The individual is getting their monthly interest-only payments, their cash flow, their capital is getting put to work. And then there's obviously, like you mentioned, there's business lines of credit that could potentially be pulled down to be used. You just got to be careful with that, with the timing, because some business lines of credit might have, a very short deadline. It might be you could only have this capital for 6 months. You can only have this capital for 12 months. And then whatever the interest rate is, obviously, you want to make sure you're charging above whatever that interest rate is. Otherwise, your business is negative every month. But yeah, there's a wide variety of sources. So it could be self-funded. You could do brokering. You could do business lines of credit, debt fund, warehouse line of credit if you get big enough. There's even white label funding. So once you have enough experience and enough what they call loan tape, you could go to some of these bigger companies and say, hey, I would like to be able to close loans in my name, but they will fund it, which is white label funding. So there's so many different ways to build the business. It's just a matter of what are your priorities and, what do you want to do and what's the timeline you want to do that in.
Sure, like I do invest in a multitude of different things. I like diversity, but I probably have, I would say, 80+% of my, of my investment in some form of real estate. And the reason for that, the reason we kind of picked that is there's not really that I know of any better, maybe the exception of buying businesses, but like there's not really any better vehicle for growing, like rapidly growing long-term generational wealth. It's an asset. You can touch it. You have full control over it. Like I don't decide what Microsoft's board of directors does when I invest in their stock, but I can dictate how I run my property and how I deal with my property. So having that input, having that control is huge. Again, it's an enduring asset that lasts for, hopefully, if it's maintained well, 100+ years. You are building that equity through multiple different sources. You have your loan pay down, like your tenants are hopefully doing for you. You have that depreciation, which, yes, there's recapture of that later on, but it's a great tax advantage. There's tons of tax advantages on top of it, like write-offs and deductions, et cetera. And you're also, in theory, hopefully cash flowing. Maybe not right away, again, depends on your strategy, but it's also going to be generating you income as well as all those other benefits where you're kind of looking more for the long term.
We've always been fix and hold guys, not fix and flip. If it was up to me, we would never sell a property ever. I truly believe that long-term net worth is built through holding properties. I'm not really like, a lot of guys out there right now probably will always have more cash and capital than Evan and I, because we are always reinvesting and buying properties and growing that portfolio. So that's always kind of been our goal. But we have sold in 20, I don't remember the year, last year, I think it was, we sold like 60 houses. So we sold a package of almost 50 to another local investor. Actually, we sold like 70 houses. So we broke off a big package deal to raise some capital to do some different asset class investments. And so we've built in the process of building a 260 unit storage facility on the south side of town. We've got the first phase pretty much wrapped up. The second phase is getting ready to break ground. And then we have 3 apartment complexes that we're in the development phase of, as well as a small little neighborhood of 12 duplexes. So what we've kind of shifted gears a little bit. We still, I mean, looking at my board, I've got 9 burrs going right now, but we're sold off a bunch in order to kind of do some more developments. And that's kind of my end goal. That's what I really like. I want to do the developments, so the multifamily, the storage. That's really where I see myself moving into the future. We'll still always do burrs, but we're going to really focus heavily the next couple of years on new builds, and just kind of developing here around town.
Compared then to now, the difference between long-term and short-term rentals is generally the same, where short-term rentals are going to bring in a higher daily rate. If you think about it, you're really, and it's not nearly as passive. You're operating a hotel at this point, but that means more income, right? You know, a hotel room rents for $100 to $300 a night, depending on a market. That's far more than just a whole house alone in a market would rent for. So you just kind of look at that comparison. Short-term rentals make more money, and you can self-manage them. You can self-manage 1 or 2 pretty easily. Once you get a kind of a handful, it gets to become really tiresome, you know? So I learned very quickly how to automate and how to build a team around that, virtual assistants and local folks and things like that. So I became really good at managing short-term rentals from afar because it became necessary for my cash flow goals. But generally, you know, it really depends again on the market saturation levels at this point. But you're looking at close to double the total cash income, gross revenue on a short-term rental. It could be 3 or 4x depending on the market. It could be slightly less in some. The danger right now is that a lot of folks are still looking at 2022 numbers, like the inflation, all this extra money that came around. Well, shoot, short-term rental nightly rates went up 30% in 2022. Guess where they're not at anymore, right? So people bought those properties at top dollar with low interest rates, thinking, hey, I'm going to print all this money. Well, no, we're back to kind of 2020, 2021 rates now. So if you had to still buy right for that to still make sense. So short-term rentals has gotten a lot harder. It's not impossible. The key, in my mind, to short-term rentals right now is to either focus on burr properties, where you are actually doing a renovation and improving the property, as well as focusing on super unique, super Instagram-worthy properties. I mean, you can make a house down the street super unique and super cool. And that's going to bring you to the top of the list. But even more unique properties, like I have a geodesic dome in Colorado, always full because it's so unique. It's so cool that little 2-bedroom dome is still renting for $250 to $400 a night, depending on the season. So really, uniqueness is where it's at for short-term rentals, since so many investors got into that space. I would advise anybody that wants to get into it to focus on that. And if you are trying to get into short-term rentals for the first time, go buy one in a market that you'll actually use and can take your family to. That's how we got started, and it was like, this is a game changer, right?
So we actually do use something called Door Loop for our property management software. So what that means is, imagine there's 3 main players here. There's the asset itself, there's the property manager, and then there's the owner, right? So if it's in a line, the property manager works with the asset, and then the property manager works with the owner to give information back and forth, right? So what we're really trying to do is not compete between property or asset and property manager, but we're trying to compete between property manager and owner on the tech we're building. So it's all about communicating what is going on in the portfolio and also connecting all of your partners that currently you are manually connecting with through like email or going to meet at the bank, right? Or basically the hyper in-person and super non-scalable partnership management side of things is what we're really tackling. So the way we're trying to build it is asset goes to appreciate. Appreciate is a central module and command center, if you will, where each player, including yourself, any of your business partners, whatever, can interact with the data of the asset in real time. All inspection data, all risk data, all financial data. And then you as the owner can very easily work with the same center or source of truth with all of these different people, see what's going on in real time, and make decisions that are not only faster, but are backed by actionable data. And so that's really where we're competing.